Welcome to our CFP exam prep discussion on 457 plans and non-qualified deferred compensation plans, specifically focusing on government and tax-exempt entities. Let's break down these complex retirement planning vehicles that frequently appear on the CFP exam. The 457 plan comes in two distinct flavors. 457B plans are for governmental entities and tax-exempt organizations, while 457F plans are exclusively for top-level executives in tax-exempt organizations. Understanding this fundamental difference is crucial for the exam. Let's focus on 457B plans, which are often misunderstood by exam candidates. Unlike 401k plans, 457B plans have a unique advantage. The contributions to these plans don't count against the limits for other retirement plans. This means an employee could max out both a 403B and a 457B plan in the same year. A common exam mistake is assuming these limits are combined. The annual contribution limit for 457B plans matches other qualified plans at $22,500 for 2023. However, here's where it gets interesting. The special catch-up provision for 457B plans is different from other retirement plans. In the 3 years before normal retirement age, participants can contribute the lesser of twice the annual limit or the sum of unused deferrals from previous years. This means potentially up to $45,000 in 2023. A critical point that trips up many exam takers is the coordination of catch-up provisions. If someone is eligible for both the age 50 catch-up and the special 3-year catch-up, they must use whichever provides the larger benefit. They cannot use both simultaneously. Another unique feature of 457B plans is the treatment of early withdrawals. Unlike other qualified plans, there's no 10% early withdrawal penalty before age 59.5. However, distributions are still subject to ordinary income tax. The exam often tests this distinction. For governmental 457B plans, the rules allow for rollovers to other qualified plans like IRAs or 401ks. However, non-governmental 457B plans have more restrictions. These plans must remain separate and cannot be rolled over to other qualified plans. This is a frequent source of confusion on the exam. Let's address a common misconception about vesting. While employer contributions to 457B plans can have a vesting schedule, employee deferrals are always 100% vested. The exam might try to trick you by presenting scenarios involving vesting schedules. When it comes to distributions, 457B plans must begin required minimum distributions by April 1st following the later of age 72 or retirement. However, for non-governmental 457B plans, the assets remain subject to the claims of the employer's creditors. This is a crucial risk factor that distinguishes them from governmental plans. Remember the unique triggering events for 457B distributions. These include separation from service, death, disability, unforeseeable emergency, and reaching age 72. The definition of unforeseeable emergency is more restrictive than hardship distributions in other qualified plans. To master this topic for the exam, focus on 3 key areas. First, understand the special catch-up provision and how it differs from other plans. Second, remember the unique early withdrawal rules. Third, know the distinctions between governmental and non-governmental 457B plans, especially regarding rollovers and creditor protection. By understanding these nuances and avoiding common pitfalls, you'll be well prepared to handle 457 plan questions on the CFP exam. Remember to read each question carefully, as the details matter significantly in this topic area.